Good morning and welcome to the Killik podcast. It's been another big week for the German bund and the effect of the German bund on other markets. So we've seen more volatility as the German bund has bounced off very low levels in terms of the yield. And you know, if we look here at the long end of the curve, the 30-year German bund was trading at 0.47 about 2 weeks ago, which was the lowest level of any major economy in history. So we're coming off very suppressed yields because of QE, but the moves have been quite big. So we've got to think about why it's moving and what the implications are for other asset classes. So our conclusion is that unlike in 2013 when we had the taper tantrum, which was very damaging to some equities, this move is because of reflation. And this is because the market is now starting to take deflation off the table and feel that we're starting to see growth in Europe. And obviously the oil price is coming off very low levels, so that's going to help inflation numbers. So bond yields at these artificially low levels are wrong, and therefore we've seen quite a steep move up in the long end of the curve. What we need to have a look at, in terms of looking at this in terms of the equity market, is what's happening in corporate bonds and whether we've seen the corporate bond market sell off in the same way as the government bonds. And that would suggest that there's more concern about earnings, but we haven't seen that. So we've seen what they call the spread tightening between the government bond and the corporate bond, as corporate bonds haven't sold off, but the government bonds have. So that's actually good news for equities. And we've seen a similar sort of picture in the equity market. So the equity risk premium, the amount of additional return you're getting from holding equities, has actually contracted as the bond yield has gone up, or the risk-free rate has gone up. So again, that's the sense that people are getting less worried about growth and therefore are more relaxed about holding equities on a lower relative return to bond yields. So in the UK, most of the action has been at the long end of the curve. So here we go. We've seen since April quite a shift in the long end. So that's kind of on from 10 years onwards. But the short end has remained anchored. And this week we had Governor Carney talking about various issues, but one of the key issues that we drew from his statement was that the monetary policy would react to fiscal policy. And I think one of the big issues or ramifications of the Conservative election victory last week is that you will see further austerity. So fiscal tightening could be a key issue that comes out of the autumn statement, and therefore monetary policy has to adapt. And therefore market is starting to push out again the chances of a rate rise in the UK. And therefore you've seen at the short end the yield curve hasn't risen, but at the long end it has. So who benefits from this steeper yield curve and this reflation trade? Well, we've been talking about it a lot recently. It's the financials. So that net interest margins will rise because they're paying at the short end, but they're receiving at the long end. So they've been a sector that's outperformed so far this year, and particularly over the last couple of weeks. Equally, energy has bounced well. Another reflationary trade. Commodities also are in that bracket. So we now see the S&P here at quite a key juncture. So we've been hitting up against this top support for a number of months now, but the lows have been getting higher. So we've got what the charters call a pennant, and typically you get a break one way or t'other, and we'd be hoping and quite optimistic about the S&P now breaking to new highs as the economic data starts to pick up, which it didn't this week, but we still anticipate will as we go through the year. Looking at the week ahead, it's a reasonably heavy reporting week. So key for us are Vodafone and Land Securities on Tuesday, Marks and Spencer's on Wednesday, United Utilities and National Grid on Thursday. On Tuesday, we've got Vodafone. We think this is a really strong story with a very good 5% forward yield. So key things to watch on the results for this week is that we're seeing further consolidation in the industry. So one of the reasons we like European telcos is that we are seeing consolidation, which is boosting margins for the incumbents. So we're taking out some of the smaller players, and the bigger players are getting bigger. This has been encouraged by the regulator because they've seen the success of a more consolidated industry in the US, and the infrastructure investment that's gone in because of those higher margins, and therefore the better service that consumers are getting. So we want to continue to see signs of Vodafone consolidating, and a potential bid for Liberty could be one of those. Equally, at the technological level, LTE or 4.5G is now becoming more prevalent. So in the UK, for Vodafone, 20% of their subscribers are currently on LTE, against around 70% in the US. So we continue to think that more subscribers will move to LTE, which means they'll be using more data at higher margins. This was obviously facilitated by new devices, the new iPhone 6, larger screens, and a more prevalence of videos and data going over the internet. What we're seeing here in terms of longer term is we think that the average revenue per user could grow by about 25% over the next 5 years. And we've already seen a 7% increase in the growth rate in average revenue per user from 2013 to 2014. So it's gone from a slowing down in terms of revenue to an acceleration of revenue for the first time in quite a long time. So we think these European telcos are at an inflection point in their revenue, and they're highly geared. So for Vodafone, a 2% revenue growth will result in a free cash flow increase of about 10%. So clearly, with their very disciplined approach to returning cash to shareholders through their dividend yield, we can see significant potential for that yield to grow, and therefore we think the shares remain very attractive. So that's it from me. Have a good weekend. Thanks very much.